If you are 60 years old and 100% of your portfolio is in the stock market, now is the time to ask yourself, can you handle emotionally seeing half or potentially more of your portfolio erased if we enter a recession and a corresponding crash in the stock market occurs? Losing money at age 60 is a lot different than when you're in your early 40s. The reason I say that is that we have been in a bull market for stocks since early 2009. It's been 16 years. 2008 recession was 17 years ago. You've had the wind at your back for well over a decade. We've been in a tremendous bull market for a long time. It's getting long in the tooth. It may not continue that much longer. Eventually, the business cycle is going to turn. Recessions are real. I know it's like Sasquatch, right? Like we're all looking for it and we haven't seen it for quite some time. But unlike Sasquatch, recessions are real. It's going to show up. And when it happens, it's going to catch you off guard. So what I'm seeing right now is very similar to what I saw in the late 1990s when I met dozens of people who were on the verge of retirement, around 60 to 65 years old, and their portfolio was heavily allocated, if not entirely allocated, to growth mutual funds. By 2002, they were cursing those mutual funds. So many people had their retirement dreams turned upside down. And I feel like we're about to repeat that all over again. The secular bull market of the last 16 years has made you rich. You probably have millions of dollars now. But at age 60, if you lose half or more of your money, it's not going to be nearly the same as when you were in your early 40s almost 20 years ago. Maybe you only had a couple $100,000 then. 2008 was not so bad for you because you were optimistic about the future. You still had a lot more years to work and to rebuild. You were willing to take risk then. Why take those risks now? I've met with over 300 wealthy families throughout my career. I've had firsthand opportunities to see how people 60 years old and older react to losing half or more of their money. It's exactly what happened back in the year 2000 and 2008. In all cases, my experience has been that when somebody is age 60 or older and they see half of their portfolio wiped out, it is like a coat of bricks on their shoulders. Generally, they didn't think it could happen. Many times I've met people who had a financial plan and they just disregarded the risk assessment of the financial plan. They thought, well, it's just not going to happen, or I'm going to get out. I'm going to get out before the crash occurs. But let me tell you, when the crash happens, and eventually we will see a crash, when it happens so fast, before you know it, you've already lost a third or more of your money. And if you get out, now you have abandoned your financial plan. Throw your financial plan in the trash. It's over. If you get out at the bottom, like so many people did circa 2002 and 2008, your financial plan is upside down. One of my anecdotal barometers that the business cycle may be about to change is that in recent years, investors have become obsessed with relative performance. They want to beat the stock market. They want to do better than the S&P 500. The last time I saw that was 1999. In 1999, the Janus funds were advertising nonstop about how their growth funds were so great at beating the market. And I can't even tell you how many people I met. It's probably more than I've got fingers and toes, who were all in on the Janus funds, and they were attempting to beat the market. And why is that? At the end of a secular bull market, people become focused, hyper-focused on relative performance. But then, when the inevitable crash occurs, people want absolute performance. They don't want to lose any money. They don't care anymore about beating the stock market. They just don't want to lose. So I feel that all the signs are there that we are late stage bull market, and the business cycle is probably going to turn in the next few years or possibly much sooner. There are many signs right now warning us that a recession is probably close at hand. In December of 2024, a young professor wrote a so-called research paper advising that retirees should be all equity, 100% stock market exposure for the duration of their retirement. I made a video about this. It's Beyond the Status Quo research paper. I would encourage you to watch that video. I think it's extremely irresponsible. An all equity portfolio for someone who's 60 years old or older is for a very select few. Only a small percentage of investors have the emotional appetite for risk to tolerate that type of volatility during their retirement. I agree with the researchers' findings that if you're 100% stock market exposure for your entire life, you're going to make more money, right? You'll probably compound your wealth at 10% and you'll end up possibly with a lot more money. But none of us know exactly when the next recession or crash is going to occur. And if you're retiring at age 65 and you're going to have a 30-year retirement, you're going to see multiple crashes and recessions throughout the course of a 30-year retirement. So it's not if, it's when you will be forced to deal with a significant drawdown of your retirement portfolio. Very few people can handle that emotionally. The professor who wrote the Beyond the Status Quo research paper suggests that retirees who use an all equity portfolio for their entire retirement will have more wealth to leave as an inheritance to their beneficiaries. True or false? You don't know what your timing will be with respect to when you're going to die and when the next crash will occur in the stock market. So what if you're all equity in retirement and you get close to the end of life and unfortunately you have bad timing at the end of your life and the stock market gets routed? It just falls off a cliff because we've hit a recession or a war or a pandemic or whatever. Now there's a lot less money for your beneficiaries. It's much more predictable how much you can leave to your beneficiaries if you have a diversified portfolio. Let's apply the same logic to the front end of your retirement. If you're 60 years old and you're using a diversified portfolio, you'll have a lot more predictability and control over an uncertain future than if you are 100% equity. The bottom line here is that you need to look yourself in the mirror and say, how will I react if I lose half or more of my portfolio at the onset of my retirement? If the answer is, I'm not sure, you shouldn't be 100% equity at age 60. It's time for a reality check. Here's another way to evaluate your portfolio decision. Let's say that you were thinking about getting a surgery, especially an elective surgery, and your surgeon said to you, hey, there is a 15% chance that you will have severe complications and possibly death. How would that impact your decision to get the surgery? The stock market is the same way. In the last century, we have had 15 recessions. There is a random probability of about 15% that in any given year, we could have a recession. Recessions occur about every 7 years. Now, nobody knows exactly when the next recession is going to occur, although I do think we're close. But you can be confident that there will be recessions in the future. And so what if your timing is bad? You're 60, 65 years old, you're getting ready to retire. You've got at least 15% odds and possibly much higher that you're going to have a recession and probably a corresponding crash in the stock market. Do you want to gamble with that? The problem with being all equity at age 60 is that if your timing is bad as you get close to retirement, you're not going to know it until it's too late. So that should give you pause. and help you think about should you be 100% stock market exposure as you're getting close to retirement. Maybe it's time to think about diversification. Again, I want to repeat that I'm a big believer in stocks for the long run, and I do believe that equities are the best wealth creator that there is. But very few people have the emotional appetite for risk and the tolerance for the volatility that comes with an all equity portfolio. Just because you can make more money having all stocks in retirement doesn't mean it's the right decision for you. Everybody's unique in how they feel. You should only be 100% stocks in retirement if you have a high tolerance for risk. And in my experience, that is very few people. I can't tell you how many people I've met over the years who said that they were high risk tolerance. But then as soon as they started losing money, they freaked out. Their risk tolerance changed. People's attitudes and opinions change as they get older. How are your attitudes and opinions changing, especially with respect to your risk tolerance? If you have questions about your investments, please give my office a call. We would be happy to give you a free second opinion on your portfolio. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.